In this video, we're looking at AT&T stock, ticker T, and Verizon stock, ticker VZ. Usually these stocks are bought by dividend investors, and in this video, we're looking at their dividend yield, their payout ratio. We're looking at what analysts are projecting for their free cash flow to be in a couple of years. And in the end, we're going to compare their valuation. We will use free cash flow yield as a valuation metric. So the goal here is to determine which stock is a better buy at the current price level. So let's get started. First of all, if you want to make a deeper dive on AT&T stock or Verizon stock, please write in the comments below. Okay, let's start by looking at their price performance for the last year. As we can see, it is -20 for AT&T stock and -28 for Verizon stock. So the price performance is really disappointing. So is it a good time to buy these companies? Will this trend continue? But both Verizon and AT&T stocks are usually bought by dividend investors. So next, let's look at their current dividend yield. We can see that for Verizon, at the moment of writing the video, this is close to 7%, 6.86%. For AT&T stock, this is close to 6%. The dividend yield for AT&T stock will be much higher if not the spin-off of Warner Media about a year ago. Also, for the last 5 years, the average dividend yield for AT&T stock is around 6.6%. On the other hand, for Verizon stock, this is close to 4.8%. So on average, this is very high dividend yield for Verizon stock. Okay, let's look into the future in a couple of years. So let's find what will be the dividend yield in a couple of years for both AT&T and Verizon. So we're using analyst projections for that. So according to analysts, in 2 years for Verizon stock, the dividend per share will be close to 2.7. For AT&T stock, it will be close to 1.13. So again, this is according to analyst projections. Also, if we look at their free cash flow, in 2 years, it is projected to be close to 19.5 for Verizon and close to 18.1 for AT&T stock. So later we will use these free cash flow projections to make the variation of payout ratio. So let's bring all the data to the table. So the first row is the current price at the moment of running the video, number of shares outstanding at the end of last quarter, the free cash flow projections in 2 years that we just saw, 18.1 for AT&T and 19.5 for Verizon. Next comes the dividend per share. So how do we get the amount that is spent on the dividend? We multiply the number of shares by the dividend per share, and we get the projected dividend. So according to analysts, it will be close to 8 billion for AT&T and 11.3 billion for Verizon stock. So this is the amount that is spent on the dividend. We will later use this number to get the variation of the payout ratio. So first, let's get the dividend yield. So this is the dividend yield that is projected to be in 2 years. We divide the dividend per share by the current price. We get the dividend yield for AT&T stock in 2 years of about 6%. For Verizon, it is close to 7%. So a little bit higher for both companies than it is right now. So dividend yield, of course, if the price stays the same, which is highly unlikely, the dividend yield is projected to be a little bit higher than it is today. We also can get the variation of the payout ratio. So we divide the amount that is spent on the dividend to their free cash flow. Again, both numbers are projections in 2 years. So this is around 45% for AT&T stock and 58% for Verizon. So according to these numbers, for both companies, the dividend seems to be stable. They have more than enough free cash flow to pay their dividend. Okay, so we saw the projected dividend yield in 2 years. We saw the variation of the payout ratio. So the dividend seems to be high and stable. Okay, now let's look at another metric. Let's look at return on capital. So there are several ways to get the return on capital. I took this data from Ticker Terminal. They measure it as EBIT, which stands for earnings before interest and tax, divided by capital, which is equity plus debt, also plus the deferred tax. And if we compare Verizon and AT&T stock, it is 10.45 for Verizon and close to 9% for AT&T stock. So according to this metric, Verizon manages its capital more effectively than AT&T. Okay, so we looked at their dividend yield, their payout ratio, the return on capital. Now let's look at their current valuation. We will use free cash flow yield as a valuation metric. We will compare their free cash flow yield compared to its own history. So let's look at their chart of free cash flow yield. So this is next 12-month free cash flow according to analysts divided by the current market cap. So how much the company brings free cash flow compared to its market cap? We can see that for AT&T this is more than 12%. For Verizon this is 10.77%. So a slightly higher free cash flow yield for AT&T. But if we compare that to their own history, so for AT&T this is in line with the average free cash flow yield for the last 5 years, while for Verizon the free cash flow yield for the last 5 years was around 8.4%. So according to its own history, Verizon seems to be undervalued if we use free cash flow yield as a valuation metric. So let's bring all the data to the table. So I take the current price at the moment of running the video, we get their current free cash flow yield and compare it to their average free cash flow yield. As a result, if we use this metric, we get that AT&T stock is trading around its fair value, while Verizon stock has about 28% upside. So Verizon stock seems to be undervalued. Okay, so we looked at AT&T stock, we looked at Verizon stock. Both companies can be a good choice for dividend investors. They have high dividend yield, stable dividend, and relatively low payout ratio. Personally, I like Verizon a little bit more because of their higher return on capital, lower valuation compared to its own history. But again, both companies can be a suitable choice for dividend investors. Also, if you want to know more about Warner Brothers Discovery, a recent spin-off about a year ago of Warner Media, here's the video. If you are not subscribed to the channel, you can just by pressing the button right here. You will not miss a single new video. Thank you very much for watching till the end and see you in the next video.